Hello and welcome to BYJU'S Exam Prep IAS. Welcome to another session of economy this week, wherein we are going to take up all the important economy related articles which have appeared in various business related newspapers from 12th to 18th November 2022 and have a detailed discussion on these articles. Let's begin the discussion for this week. The first very important article, HK funds may come into India via Mauritius. Now what is this HK funds? HK stands for Hong Kong. Now what is the concept here? Follow this very carefully. Generally, whenever investments will take place or will flow from one country into another country, let's say country 1 to country 2, the investments will attract taxes. Now if both the countries, that is C1 and C2, impose the taxes on the same tax base, then this is called as a double taxation. That is, in let's say a simple example, imagine this investment will lead to dividends that are earned by the investor who has invested in the shares of a company which is located in country 2. Now on these dividends, if country 1's government as well as the second country's government will impose a tax and collect that tax, that is called as a double taxation. In order to address this, generally these countries enter into an agreement which is called as double taxation avoidance agreement. And under the double taxation avoidance agreement, in short DTAA, the taxation powers on what tax base the governments will be imposing a tax, the taxation powers are distributed between the two countries. Now this is one point. Now when I will simply say, sir, how it is connected to the article given here. The connection is that India and Mauritius have a double taxation avoidance agreement. And now Mauritius and Hong Kong have signed the double taxation avoidance agreement. Now once this DTA is ratified by both the members or both the countries, we will start expecting that the funds from the Hong Kong will start flowing into Mauritius, and from the Mauritius the funds will flow into Indian economy. This is why the article is there in the discussion. Now related to this, certain very important points. Whenever the DTA is signed, either these could be a very comprehensive DTAs or DTAs which are focused on certain types of investments, certain types of transactions. These could be very narrow in terms of coverage or very wide in terms of coverage. Let me go to the next point here. Already the Hong Kong investments are there in the Indian market. Many of you think that if Hong Kong will start investing through Mauritius, this is the first time they will be investing in India. That is wrong. Already a lot of FDI, foreign direct investment, and foreign institutional investments are flowing from Hong Kong to India. But the problem here is these investments do not enjoy any tax benefit. I repeat, these investments do not enjoy any of the tax benefits. And by routing these investments through Mauritius, because the Mauritius and India have a DTA, and in that particular context the tax rate on some of the investments are lower, and some of these transactions attract a 0% tax rate. And that is a precise reason we might expect investments from the Hong Kong to be routed into India through Mauritius. Next point, will all these investments enjoy tax benefit? Obviously the answer should be no here. But many of you simply say, sir, but based on whatever you have discussed until now, this tax benefit should be extended to all the transactions or all the investments. Not necessarily. There is this concept of GAR, General Anti-Avoidance Rules. I repeat, General Anti-Avoidance Rules. If there are transactions or such an arrangement which is done, as a result of which the parties involved in the arrangement enjoy a tax benefit, enter into a tax avoidance, such transactions can be disqualified, or such tax benefit under GAR can be disqualified. And that is the precise reason, please understand this. Any transaction or any investments that will flow from the Hong Kong to Mauritius, it is expected to it is expected to enjoy the DTA benefits, that is the tax benefits, by meeting certain threshold restrictions. By meeting these particular restrictions which are provided under GAR, these transactions or these investments will be rooted and they will continue to enjoy, or they will start enjoying the tax benefits. So these are certain very important points regarding this piece of article which was published in the Financial Express. Now based on this, I have given a very interesting question. Consider the following regarding double taxation. It occurs only when the tax base is taxed at full rates. What do you mean by that? Imagine a dividend in India is taxed at, just a hypothetical number, let's say 20%. So if the dividend is taxed at the full rate at 20%, does it mean it is being double taxed in both the countries? Not necessarily. Either the tax base is imposed with the same, that is the full rate of tax, or even the partial rate of tax. But if it is taxed in both the countries, then this will basically lead to a double taxation. So the first statement is wrong. Even at partial rates also will be counted as a double taxation. Is taken as a double taxation only when the national government taxes twice. Again, very niche area. Statement 2 is wrong. Meaning what? Let's say you are an investor. You have invested in the USA. Now government of India will impose a tax on this investment, collect money from you, that is tax. But on the same amount of money, that is a tax base on which government of India has imposed a tax, what if one of the state government in USA will impose a tax? Will it be counted as a double taxation? Of course, yes. It is not always that the central government or the national government imposes tax in two places, that is in two different countries, that will be double taxation. No. Even if the state government or any other tier of a government will impose a tax at two different countries, in two different countries, that will also be counted as a double taxation. Second statement is also wrong. Right option for the question will be option D, neither 1 nor 2. The next article is regarding online fin-fluencers on SEBI's radar. Now what is this fin-fluencers? I'm pretty sure all of you heard of influencers. In the same way, the financial influencers on the social media are referred to as fin-fluencers. The basic idea is simply this. If you have watched a video on a YouTube, you have watched a video on, let's say, certain other social media platforms, where there are certain, let's say, investors or the experts who are giving you recommendations or tips as to how to invest, in what stock to invest, etc. These will be referred to as fin-fluencers. And SEBI says all of these will be under the SEBI's radar now. Will start regulating all of these influencers or the financial influencers. Now why is this being done? If I have to take you back, if you need to understand this, there is a small story here. Understand the story. Couple of months ago, the market regulator broke down or basically went after certain types of WhatsApp groups as well as Telegram groups. The argument that was put forward by the market regulator was that the people who are running these WhatsApp as well as Telegram groups are front running. Meaning what? They will basically give you an advice to invest in certain stocks, etc. But they already have an interest in the stock. Meaning, let me give a very simple example. Just imagine, I'm not recommending this. Imagine, I tell you to purchase the stock of company XYZ tomorrow. And assuming all of your investors, you will go to the market tomorrow and start purchasing the shares of XYZ company. But what I would have done is, today itself, I would have purchased shares of company XYZ, and tomorrow when you start purchasing, the demand goes up, the price goes up, I will sell the shares of XYZ at a higher price, thereby making profits or gains. This is basically concept of a front running. So SEBI found out that there are certain parties which are involved in the front running, and they are also running these particular, let's say, WhatsApp groups as well as the Telegram groups, misleading the investors, directing the investors to do something in the market. after the action was taken on those platforms, now SEBI says we will target the social media. We'll target these influencers who are there on the social media, who are trying to give expert advice to the investors, and this could be misleading because they might have certain interest in the advice that they are giving. So SEBI says we will basically introduce a new system and try to regulate these financial influencers. So this is the second article. This is the second article for this week. Let me go to the third very important article. Udan levy on the airlines will be doubled to 10,000 rupees and then tripled to 15,000 rupees after a couple of years. Now what is this argument? Udan, as all of you know, it's a scheme which has been launched by the government, Ude Desh Ka Aam Nagrik, where central government says we want to make flying affordable. Because there is a very small population in India which can afford to fly, because the prices in the flight or the airline service providers, the charge is very high. It is out of reach of many of the population or most of the population in India. In addition to this, government under the Udan scheme wanted to target certain number of routes, operationalize these particular routes, 1,000, and wanted to target certain number of airports in lower cities or smaller cities, 100 airports, and wanted to operationalize these airports. Now what has been achieved regarding the airports as well as the routes, I'll come to that later, but understand what is there in the discussion now. Government under the National Civil Aviation Policy of 2016 proposed, or under that itself proposed, the idea of the Udan scheme, or other name for this is Regional Connectivity Scheme. Under the Regional Connectivity Scheme, the objective was government wanted to ensure that the flight operators or civil aviation providers, that is the private sector companies, will start providing the services in tier 2 as well as tier 3 cities. They will provide the services and provide the services at an affordable price, so that the people living in these particular cities will start utilizing the services. In order to achieve that, NCAP proposed the concept of National Civil Aviation Fund or Regional Connectivity Fund. Okay, Regional Connectivity Fund. And the objective was 80% of it will be coming from the central government and 20% will be contributed by the state governments. And this 80%, basically the contribution to the RCF was expected to be collected by imposing levies, that is Udan levy, on every departure of the flight. Now remaining 20% would come from the state government. Now we would use the RCF, Regional Connectivity Fund, to provide viability gap funding for civil aviation companies, that is airline operators, who are going to provide or sell the tickets, provide the services at subsidized, rather than using the term subsidized, at lower rates. They would be provided with viability gap funding through this mechanism. Now central government says we targeted 1,000 routes, 425 have been operationalized, 575 are on track. We targeted 100 airports, 68 have been operationalized. So we want more funds. We want to generate more and more funds so that we can provide the Udan, or we can promote the Udan scheme much further. In order to achieve that, the government now says the Udan levy, which was until now 5,000 rupees for every flight. I repeat, 5,000 rupees for every flight, that is every departure, now will be doubled to 10,000 rupees till the end of March 2023, and after March 2023, that is starting April 2023, it will be tripled to 15,000 rupees till the end of the April 2027, thereby ensuring that levy which is increased will lead to higher amount of revenue collection under the RCF, and now the funding under the RCF can be provided to more and more airline facilities or airline companies, or can be used to promote Udan scheme here. But apart from this, what are the other important points given here? every airline operator who was covered under the Udan scheme, who was asked to contribute to the RCF, every airline operator used to transfer this particular expenses to the consumer, to the flyer, in the form of 50 rupees added in the every ticket. Every ticket that we have purchased in recent times, out of the pricing on the ticket, 50 rupees has been included as a charge to be collected and to be provided under the Regional Connectivity Scheme levy. That is Udan levy or RCS levy. Now the concern regarding this is, if the government increases or doubles the levy to 10,000 and further triples the levy to, let's say, 15,000 rupees per flight, it is expected that there will be a snowball effect, and that will lead to increasing price of the tickets that the purchasing or the buyers will have to purchase, thereby affecting, to a certain extent, the demand or increasing the flight tickets prices much higher, to a much higher level. Already the concern is that because of the aviation turbine fuel prices, the ATF prices have increased in the recent times to more than 50%. As a result of this, the ticket prices have increased. Now with this particular news, again there is an expectation that the ticket prices will become much more dearer. So these are certain important points regarding Udan levy. Now based on this, I have given a question here. Consider the following statements regarding RCS Regional Connectivity Scheme. The NCAP envisaged Regional Connectivity Fund, that is National Civil Aviation Policy 2016. Statement 1 is correct. VGF provided will be from the RCF, Regional Connectivity Fund. Statement 2 is correct. The RCF has contribution only from the center. Underline the term only from the center. Third statement is wrong. 20% of RCF contribution will come from the states. So 1 and 2 are correct. Right option for the question will be option B here. Let me go to the next article. One more set of reforms which have been announced by SEBI. Now the market regulator now has brought out a new set of guidelines which will facilitate or which will promote online bond platform providers. I'll start using the short form here. OBPS, online bond platform providers. OBPPS. Now what is this OBPPS? We can purchase the securities directly from the stock market. It is allowed. We can purchase it through other means also. But SEBI says, whenever there is an electronic mechanism, a digital mechanism, using which is not a stock market, remember this, which is not a stock market, using this digital medium, if they are selling the bonds, if they are offering the bonds, then this will be referred to as online bond platform provider. Now why SEBI is trying to regulate this segment? Reason is very simple. As of now, there was no regulation on online bond platform providers. No regulation. Second, in recent times, more and more institutions, or let's say the companies, have started providing this kind of a service where they are going to sell the listed or unlisted bonds of various issuers in the market to the common man. That is very dangerous. To the common man, retail investors such as you and me. Now the concern is, one, these are not regulated. These are trying to sell the bonds of various issuers in the market. So if there is any risk taken by the retail investor, there should be certain amount of regulation involved in such a system. And citing this, SEBI says, henceforth these will be some of the very important regulations or the guidelines which we will be using to regulate OBPPs. What are these? One, these will have to be registered as a stock brokers. Remember this. These will have to be registered as a stock brokers. And those which are already providing the services, 3 months time period has been provided. They are supposed to be registered as stock brokers by then. Second, these will be offering unlisted as listed bonds and listed bonds to the investors. But there is a catch. If it is already listed, there is no problem. These are already there in the market for trading purposes. But when you say unlisted, there is a kind of a risk associated with that. SEBI says not all the unlisted bonds can be sold to the retail investors. only those unlisted bonds which are supposed to be listed very soon here. Right, which are proposed to be listed, only such bonds can be traded or can be provided for sales purposes to the retail investors in the market. So these are certain very important regulations or guidelines which have been introduced by SEBI to regulate OBPPs. Now what is the objective? As already mentioned, there is a risk component when these are selling these debt instruments to the retail investors. Second, right, and the point is, we are trying to reduce the risk that is taken by the retail investors. Second, whenever there is no regulation, whenever there is no regulatory oversight on certain financial institutions, there could be certain, let's say, mischievous activity that would be done by these institutions. Now, by bringing them under regulation, we are improving a regulatory oversight. And third, whenever there is a regulatory oversight on these kind of institutions, the customer confidence, the investor confidence in the market as well as on these service providers automatically will improve. We can attract a lot of investments or increased investment from the retail side in the bond market. And as such, it is just a factual information. As such, it has been seen that in India, the retail investor participation in the stock market is much greater compared to the bond market. And many reforms in the recent times, in the last couple of years, have been taken by RBI, SEBI, Government of India, etc. to promote retail participation in the bond market. So these are certain very important points regarding the new set of guidelines announced by SEBI. Next article, currency monitoring list. India is out of the currency monitoring list or currency manipulation list. Now what is the idea here? The USA Treasury or Department of Treasury of the USA government 2 times in a year comes out with a currency manipulator list or currency watch list. Under this, they try to find out based on 3 parameters. I'll come to that. Based on 3 parameters, they try to find out those countries which are involved in manipulating their domestic currency. Sir, what is the meaning of this? Imagine in case of India, RBI intervenes in the forex market to stabilize the exchange rate. I am using the term stabilizing here, not fixing. Remember that. RBI doesn't fix, RBI stabilizes the exchange rate. But when RBI stabilizes the exchange rate, let's say by purchasing dollars, rupee value will be appreciated or let's say will be stabilized. Other countries who are trading with India using the dollar, they will not be happy with that. Because whenever there is a market determined exchange rate, that is much more transparent in terms of determining what is the value of imports and exports. And when the central bank will intervene or the government will intervene to fix an exchange rate or to stabilize the exchange rate, obviously other trading partners will not be happy with such a system. So in case of India, which is following such a mechanism, that is market determined exchange rate, but managed in a managed way, the government of USA keeps a track of what is the intervention done by India, just like it keeps a track of many other countries. And every now and then, because of intervention done by the central banker in the market, India has been listed in this watch list, has been removed from this watch list, etc. There is no constancy here. Constancy in the sense, certain number of years India is kept under the watch list. In certain number of years, it is removed out of the watch list. And the latest information is, India has been removed out of this currency manipulator list or India or currency watch list. And to be very frank here, Government of India has never lied. It has always been opposed to this idea of USA or the Treasury Department of USA or Treasury of the Government of USA trying to decide who is currency manipulator, who is not a currency manipulator. Because as far as the Government of India is concerned, there is no fixed parameter, there is no this reasonableness which is followed by the Government of USA or let's say the Treasury of USA in determining who is a manipulator. For example, the 3 very important parameters which are followed by the Treasury are: 1, if the country or the trading partner has a trade surplus of more than $15 billion with USA. Remember this, the trading partner should have a trade surplus against USA of at least $15 billion. The current account surplus of the trading partner is more than 3% of GDP, and the central banker or that country has intervened in the market and has purchased the dollars to the extent of 2% of GDP. These are the three conditions, and if you are going to satisfy any of the two conditions out of three conditions, at least two conditions, then you will be classified in the currency manipulator list. And as the latest report is published, the report says that India, along with many other countries, is not satisfying two or three of the parameters, it is satisfying only one parameter. Hence, India has been taken out of the currency watch list or currency monitoring list. So this is the gist of the article. Let me have a discussion regarding a question on this. Which of the following parameters are considered to classify a country under the currency watch list? USA having a trade surplus with the trading partner of the country, first point is wrong. Why? The trading partner should have a current account surplus or trade surplus with USA, not vice versa. Trading partner has current account surplus, second parameter is correct. Trading partner has fiscal surplus, this is not the parameter that is considered. So second point is correct. Right option for the question is option A, only 2. Next article regarding Capex support to states which may continue even in the next financial year. Now what am I talking about? The government of India for the current financial year budget announced a scheme by the name of Scheme for Financial Assistance to States for the Capital Investment. Although the name is very technical, in essence under the scheme, Government of India kept aside 1 trillion or 1 lakh rupees. 1 lakh crore rupees, not 1 lakh rupees, that would be a throwaway amount for the government. 1 lakh crore rupees or 1 trillion rupees. And out of this 1 lakh crore rupees, 80,000 crore rupees was divided into one part, and the second part obviously would be the 20,000 crore rupees. This 80,000 crore rupees was distributed amongst the states based on the 15th Finance Commission devolution formula. Remember this, based on the 15th Finance Commission devolution formula. And remaining 20,000 crore rupees was connected or was conditional or linked to certain reforms that were implemented by the state governments. For example, Pradhan Mantri Gram Swaraj Yojana, Pradhan Mantri Gati Shakti reforms, etc. So this 20,000 crore was linked, conditional. This 80,000 crore was unconditional, was basically given to the states in the form of 50-year interest-free loans based on the recommendations which were given by the 15th FC, wherein the devolution formula was determined for each of the states. Now following this, Government of India now says in the next financial year, that is for the financial year 24 as well, we are thinking of continuing with this initiative where we are going to allocate 1 lakh crore rupees or 1 trillion rupees. Now why this is important? It has been found that the amount of expenditure under this scheme that is incurred by the central government has been very high. That is, it has allocated more and more funds to the state governments, and the important point is when the center will increase the capital expenditure, this is a type of a capital expenditure, mind you. And for the current financial year, the amount of capital expenditure that has been budgeted by the central government is 7.5 lakh crore rupees, one of the highest, 7.5 lakh crore rupees. So whenever the capital expenditure is incurred by the central government, it is generally associated with higher multiplier effect, such as investment in infrastructure, right, creation of labor, creation of demand for the raw materials, etc. So in that context, central government says the decision is not yet made, only the consultations with the states has started, although these are informal. Very soon, that is in fact today itself, there was an article in the newspaper which stated that the finance minister has started the consultations with the industries for basically the next year budget. Now over a period of time, the consultations will be done with the state governments as well, and we will have a new system, or let's say either the same amount of allocation for the next year, or it could be a different amount of allocation next year. But the center has shown interest to have a continuation in this scheme even for the next fiscal. So these are the important points. Based on this, again I have given a question here. Consider the following statements regarding the scheme for financial assistance to states for capital expenditure. It is a centrally sponsored scheme. Statement 1 is wrong. All the 1 lakh crore rupees is spent by the central government. All the funding under this is conditional. Statement 2 is also wrong. Right, 80,000 is unconditional, 20,000 is conditional. All the funding under this will be based on the recommendations given by the 15th FC. Again, this is also wrong. 80,000 is based on the recommendations given by 15th FC. Remaining 20,000 is based on the reforms that are undertaken by the respective state governments. All the three are incorrect. You are supposed to find which are incorrect. Right option for the question will be D, 1, 2 and 3. Next article, PLI for container manufacturing. What is the important point here? During the times of the pandemic, if you have observed, the freight rates increased. And the reason the freight rates increased was the cost of transportation through containers, hiring containers, the cost increased, and the reason was simple, there is a shortage of containers. The recession that has happened or the impact of the pandemic and the recovery after pandemic has not been uniform throughout all the countries. Some of the countries have been suffering, some of the countries have recovered, some of the countries are achieving a higher growth rate, although at a subdued rate compared to previous financial years, etc. There is no uniform recovery or the impact of the pandemic throughout the global market. And as a result of this, the demand for the containers also has not been uniform. In addition to this, the pandemic which affected the production in the Chinese economy affected even the manufacturing and the supply of the containers. And India, looking at all of this, has decided that we will try to promote the container manufacturing under one of the very important schemes of the government, the PLI scheme, that is Production Linked Incentive Scheme. Under this, the article says, the allocation of the funds have been allocated or funds have been done for many of the sectors. But in some of these areas, the allocation of the funds is higher compared to how much money has been given. That is, in simple terms, imagine I have allocated, let's say, 1,000 crore rupees for a particular sector, but the number of applications which have been accepted in the sector is only worth 800 crore rupees. So allocation is 1,000 and the disbursement is only 800. So I am left with extra 200 crore allocation in this segment. What can be done? Can we use it for some other sectors? Argument is yes, or the point is that yes. When the PLI scheme was implemented or designed, Government of India has made sure that there is a provision wherein unused, I repeat, unused funding, unused money which is allocated for a sector can be reused or reallocated for covering other sectors or other areas. And as per the committee report here, as per the high level committee which is headed by Cabinet Secretary Mr. Rajiv Gauba, it has decided that more than 11,484 crore rupees is remaining unutilized. We will simply reallocate it, redistribute it to other sectors. And one area that they want to cover now is container manufacturing. And initially the amount of allocation that was expected, is 800 crore rupees. But we will have to wait and see actually how much allocation would be done for container manufacturing under the Production Linked Incentive Scheme. So apart from this, they have discussed the index, the impact of the COVID, etc., and the price rise in the freight transportation. You don't have to be worried. But some of you might be thinking, sir, what is the advantage of this? Why should I read the article? In what way it is connected to UPSC? Answer is simple. Government of India has been again and again saying we want to reduce the cost of logistics. That should be very clear to you. In fact, Government of India has launched a national logistics policy not to address this. So, in addition to that reform, now you can simply say by promoting the manufacturing of the containers in India, the cost of transportation is expected to come down, import dependence will come down, and the cost of logistics automatically will be addressed. So, these are certain very important points regarding this article. Next article, Ministry has ended the probe into solar imports. Now, what is the argument here? There is this argument, or there is this concept called as dumping. What do you mean by dumping? In simple terms, imagine there is an exporter X. Exporter X will export, let's say, this pen into different countries, and let's say hypothetically the price of the export will be $100. Now don't ask me, sir, does this pen cost $100? Is it so costly? That is not important here. But when the same exporter, let's say X, will export this pen to India, the price of the export, the charging will be, let's say, $90. In simple terms, whenever the prices are suppressed artificially like this, so that their exports into a country will increase, this is called as a dumping. And now to address this, we have a duty called as anti-dumping duty. Anti-dumping duty. And under the GATT provisions, the governments are allowed to impose anti-dumping duties. And just like any other government, even Government of India has the concept of anti-dumping duties. Generally the process is, there is a company, or let's say there is an industry which will raise a concern, which will raise a complaint regarding one of the exporters, allege that there is a dumping activity going on. Then the Ministry of Commerce, that is specifically DGTR, Director General for Trade Remedies, will investigate, come out with a report, give a recommendation to the Ministry of Finance either to impose or not to impose. Again, only in case of imposing that will come into picture. No committee will give a recommendation, that is Ministry of Commerce will not give a recommendation not to impose, because in the first place, if there is no requirement of imposing, they will not give a recommendation. So if there is a requirement of imposing anti-dumping duties, safeguard duties, countervailing duties, etc., the authority will investigate, give a recommendation to the Ministry of Finance, and the Ministry of Finance is the one which will implement, that is announce such type of duties. But what is given in this article is, there was an allegation by ISMA, Indian Solar Manufacturers Association, regarding dumping of solar panels into India, solar cells and solar panels. Now looking at this allegation, which was done in the month of March, the Ministry of Commerce actually started the investigations or probe. But next point is, 14th July, the same association has sent an application to the Ministry of Commerce withdrawing the complaint, withdrawing the allegation. And because under the anti-dumping rules of 1995, under these rules, if the party which has complained is withdrawing the complaint, then the probe can be ended. That provision is there. The Ministry of Commerce says that we are going to wind up, we are going to stop, right, this probe into solar inputs. So these are certain important points. Apart from this, the article also says, because there was a complaint like this, based on this complaint itself, right, the Government of India started the probe, that is the Ministry of Commerce started the probe, and also imposed the customs duties of 25% on solar cells and 40% on solar modules starting 1st April current financial year. Right, so these are certain points which are important given in the article. Next article, inflation. The retail inflation has hit a 3-month low of 6.7%, and the wholesale price index has dropped to a 19-month low of 8.3%. Now, if you look at the print data, that is basically the CPI, which has come down to 6.7%, and WPI, which has come down to 8.3%. Look at this data, it is a very good outcome. It is a soothing outcome, or let's say it will reduce certain headache for the government as well as the Reserve Bank of India. But more importantly, the article also says, because of a favorable base effect, in the coming days, the retail inflation or the inflation levels in India would be lowering or would be moderating. And please understand this, inflation rate in India starting from the month of January this year have always remained at a higher level, higher than 6%. And in fact, if you count the data for the month of October, which is the 10th month, in all the 10 months in this calendar year, I repeat, in all the 10 months of this calendar year, the retail inflation has been above the level of 6%, which is the highest level which RBI is allowed to, which is allowed for RBI to live inflation up to that point. Beyond which RBI has to take measure, because under the concept of inflation targeting, RBI is allowed to maintain inflation at 4% plus or minus 2%, which means the highest level to which RBI can allow the inflation to reach is 6%, but for all the 10 months for the current calendar year, it has remained above 6% itself. So in terms of the importance of the news, it is a good news for Reserve Bank of India that inflation has lowered and will continue to lower because of the favorable base effect. Second very important point is that WPI also has moderated to 19-month low, because please understand WPI for many months the rate of WPI was in double digits, but now it has been lowering and has fallen down to 8.3% from 10.7% for the previous month. But much more important, within the CPI itself, if you talk about Consumer Food Price Index, CFPI, Consumer Food Price Index, the food inflation rate also has come down from 8.6% in the month of September. The food price inflation or food index has actually fallen down to 7%, which means the food articles have comparatively become cheaper in the month of October, which is a good news for both the government, RBI, as well as consumers such as you and me. So these are certain important points regarding the updated information on inflation rate, that is both CPI as well as WPI. The last article for the day, exports have contracted for the first time in 2 years. It should be a cause of concern. And what has happened here? First very important point, India wants to promote exports. You also know this, I also know this. In fact, by 2030, we have a target of merchandise exports to $1 trillion. Last year, we had set a target of 400 billion and we have been able to cross it and achieve much more than that. But the problem in this context is India's exports, rather than expanding, have actually fallen down, have contracted by around 16.6% for the month of October to $29 billion. And in addition to this, the imports, they have experienced a moderate slowdown. They have also contracted, but at a much lower level, that is 5.7%, meaning the imports have hit $56 billion, thereby increasing the trade deficit to $26 billion. And please understand, this is the fifth straight month or fifth consecutive month where the trade deficit has constantly remained above $25 billion. Now, what are the important points here? If you talk about, let's say, the top 10 countries, out of the top 10 countries, there are certain important countries which account for large portion of trade, that is in terms of exports that are done from India to these countries. In fact, many of these countries out of the top 10, we have observed that the trade with them, that is exports from India to these countries, have contracted for the month of the October. It has contracted. That's the first point. Second, is it the end of it? Absolutely no. There is a fear, there is a concern that in the coming months, these exports slowdown would be much higher. The reason is that there is a recessionary fear in majority of these countries where we are exporting, or to those countries which are major importers of India's goods. For example, USA market and the European market. And in both of these countries, fearing recession, worried about a higher inflation rate, the central bankers there have kept on increasing their interest rates. And rising interest rates automatically means lowering demand in these countries, affecting India's exports. But is it fair to say that, remember the statement, is it always fair to say that because of their concerns, because of the concerns in the European as well as the USA market, the interest rates have increased and our exports have come down? Is it always fair to throw that point? Argument is no. Yes, this is one of the factors which is affecting exports from India. But having said so, the reduction in the exports or the contraction in the exports is also an outcome of Indian government policies. Remember this. The government policies also have added to the contraction in the exports. Many of you will jump to conclusion and say, sir, how can you say that government policies have led to a contraction in the exports, etc. Right? Now, before you start typing anything against me, let me tell you the reason here. Government of India, couple of months ago, worried about lower supply of these goods in the domestic market, has imposed certain customs, has imposed certain tariffs on exports. Best example, steel. Right? Although very recently the government has announced that they would withdraw it, but anyways, not just steel, other products of the steel as well as agriculture commodities have been imposed with certain regulations like this, which will basically make these exports much more costlier in the international market. And that is also the reason why Government of India's policies, I said, are contributing to the contraction in the exports are done from Indian market to the global market. So these are certain important points regarding the last article that we would be discussing for this class. Now, before I wind up, if you have not yet subscribed to BYJU'S Exam Prep, kindly do it. If you have any important inputs or if you want to give certain recommendations, use the comment section to give us those recommendations. So these are the various articles as well as the questions related to these articles which have appeared from 12th November to 18th November in different newspapers. Thank you. Have a great day.